Welcome back, folks, to another episode of the FEX Insights podcast. I am Mark Monfort, your host from NotCentralised and also the Australian DeFi Association. We're here with an awesome guest that's coming in later today to give us his perspective from the legal side of what it means to tokenize and bring blockchain into real world finance and commercial related things as well. So we're going to hear from Eric Boone very soon from Madison Marcus. But before that, we're going to get to the news. First up in local news, we've got the latest announcement from Blockchain APAC about their top 50 list. As you can see here, the top 50 impact list returns for 2025. Conversations, discussion, and debate it drives are definitely more critical than ever. The last times that they've had these, 2023, 24, and now 25, there were some really interesting, and maybe they even had in 2022, some interesting picks for who the top people were. Some agreed, some did not. But for the most part, it was great because everyone got talking. So the voting will open up very soon. And as I say here, it's designed to cut through the noise and identify the signal precisely when it matters the most. And so very interesting stuff. Will Joe Longo and other people in the banks and regulators take out the top spots again, or will it be something else? And whilst people might complain, these are certainly interesting conversations that need to be had, because this is all about who really moves the needle when it comes to crypto adoption in this space. So for all of you that are interested in where the needle is moving and who's doing that, definitely come vote and check out Blockchain APAC's DA Top 50 list. Over to another association. This is the Digital Economy Council of Australia. As you can see here, they've got their Global Digital Asset Regulatory Summit. That's September 25th, 2025. It's on that one day. The last time they did one of these, it was a whole heap of dial-ins from all around the globe. So from the US, Europe, Asia, etc. There was a whole heap of people dialing in, and across Australia as well, to piece together what regulatory changes and innovations are looking like across the globe affecting blockchain. And it's really great to get that sort of opinion across here into Australia, reports created out of it, and we're certainly keen to help. So if you're interested in that sort of thing, check this out. Check out the link that we'll share here, some more details about why you should attend, the different jurisdictions that are involved, and if you're interested in sponsoring the event as well. Now jumping over to something else local, and it's our FEX Insights website. So here, as you know, when you go to fexinsights.netify.app, you can see the latest episode. So episode 10, you can watch it here. You can ask questions as you're watching it on screen. You can say things like, tell me about this episode. You can get some simple explanations, some FAQs. The AI will take care of it based on what's in the transcript there. So you can really get some breakdowns in maybe a language that you understand a bit better, or just like to get a quick summary TLDR. The other thing is that we've also got on this one a blog, and the blog is something new. What happens to the role of a trustee when the asset goes on chain? So let's click on the article and take a look. So some of the stuff that we highlight here are that it's a technical milestone, yes, to have trustees on chain, but what makes it truly significant, especially for Project Acacia, is how it forces traditional roles in financial services to evolve, especially the role of the trustee. And we've got a few trustees involved in our particular project at NotCentralised that we're doing for Project Acacia. So we'll hear from Eric on this more, but we unpack that shift in this blog because while much of the industry conversation around tokenization is focused on speed, transparency, programmability, the real unlock comes when we bring legal trust structures and digital asset flows into alignment. If you don't have that alignment, you can talk about all the TVL that you want, but it really does not matter. We talked about tokenized stocks in previous weeks, and if they're nothing more than IOUs, and there's even worse, not much legal recourse backing them, then there's no point. So this is really important, and it's why we are going to have a lawyer on stage here later on. So Eric has a few quotes in this. Trustees in the traditional world, we talk about the same role, but new tools. So not too much changes, it's just made more efficient. And that's what blockchain provides. So we'll talk about that and the bridging of the gap between legal certainty and digital execution. So the uniqueness of what blockchain provides is certainly going to be brought to the forefront in our episode later with our guest, Eric. Here's an article from Reuters, which is all about small public companies snapping up Ether in a new crypto gold rush. even as risks linger. So as we dive into this one, what we can see here is that according to Reuters, small public companies have dramatically increased their holdings of Ether from under 116,000 at the end of 2024 to 966,000. So just nearly $1 million worth. So it's at least $3.5 billion worth of Ether held by these smaller companies. And you can see some of the figures here from how it's changed just over the last 7 months or so. Staking can offer yields of about 3 to 4%. That's part of the reason why these companies are jumping across. Ether balances growth potential with the legitimacy of a blue chip asset. It's large enough to be institutional grade, yet early enough in adoption to benefit from future upside. That's Sam Tabar from Bit Digital. So they caution amid hype in this article as well. After disclosing plans to accumulate Ether earlier this year, the shares of Peter Thiel-backed BitMine and gaming media network GameSquare jumped as much as 3,679% and 123% respectively. So certainly figures that make it feel like a gold rush era, depending on your risk tolerance. Take that with a grain of salt. You can read more on that in this Reuters article. Another article this time is from the New York Post of all places. It's finally crypto summer for the public markets. What they highlight here is that while August is typically a sleepy month for IPOs, Peter Thiel-backed crypto firm, another Peter Thiel one, bullish, and we know some of the research that's been shared over there out of Hong Kong, appropriately named it would seem, yes, is set to buck that trend later with an initial public offering on the NYSE, the New York Stock Exchange. Sources told the reporter that the round is already oversubscribed, with 6 times more investors trying to get in than can be accepted. Blackstone and ARK Invest have some of the largest buy-ins, so worth checking out if you are interested in that. Certainly one to watch as it releases some more pictures. Fun fact, the whole of the NYSE is much more of a theater, a showcase. They don't really need all the traders there. CNBC, if you watch that financial news show, is located in there. They've got their main studio that is shown there on screen. But there's a whole lot of traders doing electronic stuff around the different booths of brokers. But yeah, they could do all of that electronically. They do tours. I've seen celebrities through there. I was lucky enough to have a friend that was able to take me onto the floor during my equity research days. So shout outs to Kenny Polcari. But yeah, just really interesting stuff that despite the IPO trends, that we do have something like bullish bucking that, and we'll see how that plays out. Another one over in the US, and this is all about Trump opening the doors for private equity and crypto as 401k retirement plan options. So the article says here from the AP that millions of Americans saving for retirement through 401k, or what we call superannuation here in Australia, could have the option of putting their money in higher risk private equity and cryptocurrency investments, according to this executive order. There is no immediate change in how people would invest part of their work earnings, but federal agencies would need to rewrite the rules and regulations to allow for this. So even if it does come from the top down, there's still actions that need to take place before this is all able to be accepted. The Republican president's orders direct the Labor Department and other agencies to redefine what would be considered as a qualified asset. So they've got lists of rules and under what can be a qualified asset. American retirement plans are governed by a law known as the Employee Retirement Income Security Act of 1974, better known as ERISA. Employers are required by law to offer retirement options that are in the best interest of their employees, not Wall Street. So we will see how it moves between presidential orders and actions when it comes to the agencies. So keep an eye out on that one. How will that play out in Australia? We shall see. And finally, in the news, there is this article here from Kiplinger. This is the Genius Clarity and Anti-CBDC Acts, what Bitcoin investors need to know. And as you can see here from this article, it talks about how President Donald Trump, who won the election in November, saw cryptocurrency prices surge from 70K to 120K. That's US dollars. So do the math when you convert it to Aussie. With the policy macro and flows aligning, Bitcoin may be setting up for a bullish end to the year, where a push towards 200,000 is no longer just a shot, but a growing probability. We will certainly not be surprised if it does do that. While the realities of finding consensus among lawmakers on cryptocurrency have delayed some progress so far, the passage of the Genius Act in July, which we detail below, shows that the industry is poised to score some major wins. So they highlight here the Genius Act. If you missed it, we've covered that in previous episodes as well. The goal is the same to get stable coins the same as legal currency, in that the value remains constant so the businesses and consumers can transact with confidence. That's what stable coins are. They talk about Tether here and its estimated $160 billion market cap. They also talk about the Genius Act, trying to find a middle ground, and that's what it's been about from our reading, having permitted stablecoin issuers, so they can't just do everything. It's not just like a free-for-all, but there are rules around it and guardrails to protect consumers. So that is interesting, and it's subject to federal licensing and oversight. And what it means for Bitcoin investors, they clarify that here. Speaking of clarification, the Clarity Act as well, known as the Digital Asset Market Clarity Act of 2025. It aims to clarify registration requirements and regulatory structures for Bitcoin market participants, including digital commodity exchanges, brokers, and dealers. Because the hard reality is that a multi-year turf war between the SEC and the Commodities Futures Trading Commission, CFTC, over who gets jurisdiction, and it depends on definitions. Is Bitcoin a commodity or basically a security? So they've got that difference over there. Here in Australia, we have ASIC that takes care of both. So less turf war fighting, but they highlight things that happened over the last couple of years here and why it matters for Bitcoin investors. And then they talk about the Anti-CBDC Surveillance State Act. So that's one that hasn't been given too much coverage in previous news that we've had, but they talk about here how the act was eventually passed in the House of Representatives also in July as a separate piece of legislation that now heads to the Senate. It's like CBDCs, how they can be thought of as digital dollars from the government, like a digital euro. And for some hardline conservatives, the idea of government-sponsored blockchains of citizen transactions veers too close to Big Brother. Now, that's all nice said and done, but with regards to how the transactions may be monitored or not, it depends on how they're deployed. So you could operationally have something where there is privacy-preserving technology, like zero-knowledge proofs, put over the top. It's the cost of doing that, though, that is in question, because whilst it might be nice to do that, it might not work feasibly if CK proofs are too expensive to run on every single transaction. The FCA, when they were talking about CBDCs, when it was popular a few years ago, spoke about putting privacy-preserving technology in that. We even see it here in Australia when they talk about privacy-preserving technology for digital IDs. Minister Bill Shorten of the NDIS has spoken about decentralized technology when it comes to digital IDs. And when you have that, there is also privacy preserving or selective disclosure that was mentioned in Parliament. They're basically talking about zero knowledge proofs. But even though you might have that, it doesn't mean that it just gets deployed on every single thing, every single transaction. We see with the layer twos, the cost effective ways to batch transactions and then group it up and deploy that to a main chain like Ethereum. How they do that with CBDCs, we will see, but they do dive into it here in this article from Kiplinger. So check that one out in the show notes. That's it for the news, and now over to the interview. And we're back, folks, and we've got a guest here. Usually we have these filmed where there's like people just calling through Zoom or Google Meets, but we're lucky enough when we do get a guest in town. This one is special. We don't usually have lawyers on this show, but it's very important to know the home truths about what we're actually going to speak about. So Eric Boone from Madison Marcus, thanks for coming along.
Pleasure. Thank you for having me.
Before we get into it, and we've worked together before, but I'd like the guests to get a bit of a background from you.
Okay.
What's your history that's led to being here in Australia and the work that you're doing now? What were the kind of things that you were doing before?
That's a long discussion. So you're trying to explain the American accent. So I started my career 25 years ago on Wall Street, working for a big international law firm. So have been a U.S. securities lawyer for many years. And that kind of led me U.S. securities, banking and finance. I was kind of a weird breed of lawyer. Usually we're very bespoke. And especially in New York, we go a mile deep versus a mile wide. But I was a bit different, and I was that mile wide with banking and finance, institutional investment, as well as securities law. I was then recruited out here by a law firm.
Wow.
So they recruited me out to kind of head up along with another partner, his U.S. securities practice, as part of a regional U.S. securities law practice. So that led up a lot of work working with Asian issuers, trustees, fund managers, and the like, kind of again being that mile wide as you have to be in Australia. So worked with basically 2 international law firms during my 18 years here.
Wow.
Yeah, so it's been a while. And then now I'm at a smaller national firm, but still very much doing that international work as a US and Australian lawyer.
Fantastic. And, well, if we can't say exactly who the groups are that you're working with, from what, even though it is more of that like mid-tier in terms of the law firm, because not many people may have heard about you guys, but you're doing some really important work with
Yes.
clients and some big name clients from what I've seen. So really interesting stuff. And we're going to dive into this article that we wrote together, that was all about tokenization and what things like look like on chain. But from your perspective, what do you think has shifted in the past year that's made these tokenization conversations more real for like legal and fiduciary roles?
Look, it's money. Everybody follows the money, right? It's capital
Yep.
flows. So
Yeah.
I think everybody's just excited about digital assets. Everybody's trying to figure out how to play in that space. And the reality is, as more people think about that, that's becoming a real reality for fund managers and the like, as trustees, custodians who are typically in. Look, we're dealing with Australia, which is a bit different with the AFSL. I find myself constantly having to explain that concept to when we're dealing with deals overseas with US investors, or we're investing into a US investee company. I have to explain the fund managers and how they're constructed and how they're set up, and that we do always have these third-party custodians and trustees. And that's partly due to the AFSL requirements. That's also due to the nature of trying to push some of the liabilities off, but also trying to reduce some of the capital requirements. So that's something that's not understood. So it's like you said earlier, we're actually a national firm, more mid-tier in that world, but yet I brought a lot of my previous work with me. Fortunately, the clients followed. And in that regard, we're still dealing with like the bigger law firms in the States as counterparties.
Perfect.
So with that said, we're seeing that where I have to explain to them that dynamic and that trustee custodian relationship. So now the trustee and custodians are trying to get their heads around that as well. Like, how do we play in that space? How do we sufficiently limit our liability? How do we understand that? How do we build that into our existing infrastructure, right? And then you have to also understand the whole concept of the trustees and the documents that sit behind there, the fiduciary duties. There's a lot of legal implications that sit around this that go beyond, well, oftentimes, what are the 4 corners of a document, right? And that for trustees and custodians and for their fund managers is trying to understand that. Like, I don't think people oftentimes recognize also the amount of funds being deployed also overseas, and trying to get all of these legal systems to kind of mesh. And as we look at a new asset class, and that exposure, and what does that look like for them in the way of managing those liabilities, that becomes a key concern.
And I think it's already a concern in the way the world works right now with trustees and the existing systems. More so even when things get put on chain, and it's like new systems to get their head around. It's new timeframes as well, because with the whole kind of blockchain space, things can happen more instantly because it's code that's running it. But we are having this great opportunity to see what that's like in an experimental way, but it's an experiment with real money, because the Reserve Bank of Australia, and we'll see what the sizes of those funds are, because the Reserve Bank of Australia, with the Digital Finance CRC Cooperative Research Centre, is doing this experiment with 24 projects. 19 are pilots with real money, 5 are just proof of concepts. But we've got trustees involved in ours, a few trustees, and we name them. There's perpetual trustees, there's AMAL, one of the biggest trustees in Australia as well. But can you walk us through, in a scenario like that, what the trustees' responsibilities typically look like, and how that's, let's call it challenged when it comes to a digital context?
I don't know if it's challenged. Well, it is challenged, I guess, at the same day. You're talking about the automation of the administration of these contracts, right? We're talking about smart contracts. We're talking about automation, the benefits, the drawbacks, right? And let's see how that plays out, because I think for a lot of trustees, it is the whole concept of, am I administering this correctly pursuant to the 4 corners of that trust deed or that document? But then I'm also doing it in accordance with my obligations and my fiduciary duties that are owed to the beneficial owners and the like, with regard to any obligations. So that becomes a key concern for them. And what is going to be the concern is those smart contracts and how they're coded and how they're automated. Are we taking all of those things into consideration? Have we properly coded in line with that trust deed to make sure that automation is correct in a way that reduces their liability. I mean, look, trustees are doing this. Trustee and custodian shops are doing big volumes of deal. So the concern for them is always how do they limit their liability to make that make sense from a cost benefit analysis, right? So that is key concern for them is limitation of liability and clear identification of what their obligations are. And that becomes a key thing that we need to make sure kind of flows through to the smart contracts. And there's some benefit there, right? Because smart contracts, the automation kind of reduces the whole possibility of human error and negligence. Right? The whole idea of willful default, like you're doing something or you're intentionally doing something in opposition to what's in the contract or your fiduciary duty. So those aspects kind of come off the rank for them. So that's kind of that should be somewhat welcomed, right? But then there is that concern of the monitoring, the overseeing, making sure that's being done correctly in line with the contract, that the automation is correct, right?
That's interesting because it's like, okay, whilst the code may take away some of these things that are concerns, there's new concerns because it's like, well, for example, how do I know if the code can be changed without my knowledge, or how can we keep monitoring to make sure that it continues to align with the agreement that we've had at the start that things don't change? There's a lot of, let's call it misconceptions around like fiduciary duties and stuff, and just thinking that, oh, okay, code's just going to fix that. But whether it's tokenization or basically another way to look at it is using blockchain programming to automate the things that are very manual. Do you think that there might be some misconceptions? Let's say it's just tech people watching this and they just go, oh, well, we can just like automate all of that and stuff. What are the things that from a fiduciary duty perspective that you think people need to take into account?
That's the thing. So I think people need to understand that, yes, you may have this document that you've agreed. But all of those provisions may not be enforceable in a court of law, right?
Interesting.
So there's that difference between what you've agreed contractually and what you have written, and its actual enforceability in a court of law, and whether that is going to still be. So look, even when we give opinions on enforceability, we always qualify to say this is subject to general principles of equity, fair dealing, and the like. So basically what you may have agreed still may not be enforceable, right? And so there becomes a key concern that, yes, you may have automated, you may have it right pursuant to that four corners of the document, but has that taken into consideration fiduciary duties? And there's no way any document, like we can produce these 200-page documents. They're not going to take into consideration every scenario that's going to come during the lifespan of an investment, or with regard to a security, or possibly a necessary restructuring that may have to occur. There's always going to be some subjective considerations that, like, so, automation, smart contracts chases objectivity. But there is still some subjective considerations that come with the administration of a trust deed. That comes with any trustee's role, any custodian's role, and they try to reduce that subjectivity as much as possible. But it's still there, right? And that's how much, and look, to also be very clear, there's ways we can mitigate that as we explore this. And I think that's what the use cases are chasing, right? By limiting it to wholesale investors. Or if we limit, basically the asset class in a way that we're going to a high level of asset. So we're not finding ourselves in those murky waters, which are going to have more liability, more subjectivity associated with them. So that becomes, I think, and as we develop the market, as we get to understanding of how do we standardize documentation possibly, right? Better standardization of documentation to allow those capital flows to increase, to reduce the inefficiencies, right? To help kind of drive the market in its development, that will kind of be cured in many ways.
It sounds as well like no matter what, no matter how much automation we need, because there is that element of subjectivity, maybe even making it easier for us to get from the harder, the higher level stuff into the murky waters sooner than normal, because things are now automated. We are always going to need lawyers, ain't that right?
That's right. Thankfully. Thankfully. Yes, we will always need lawyers. And I mean, I think you have to even understand when you see there's been a pop of many trustee shops kind of across the external landscape. And that's in part because of that subjectivity. When I say that, there are deals that are very clear, bright line, good credits, creditworthiness is there, it's going well. But when it goes to that more difficult when it starts to become a difficult credit and there's some problems with the administration of the loan or it's going into default,
Yeah.
we oftentimes see a replacement trustee shop come in place, one that has to give it more attention, that has to get more advisors associated with it. So I think people need to always understand that that subjectivity already exists, right?
Yeah.
There's always that when a credit starts to lose its quality,
Okay.
we see that shift. So we just need to be understanding of that as we look at this for those type of cases when that kind of shifts.
Okay.
Yeah.
Really interesting. I think the next part, just going back to the pilot,
Yeah.
there's this whole thing around legal technical coordination.
Always.
I think there is challenges, and we're going to try to address some of those in the pilot. But what do you think stands out looking at the stuff that we're trying to do here with tokenizing, the securitization, and not just one part, by the way, like we're doing a whole kind of end-to-end workflow, but what do you see as like a really big legal technical challenge? I'm sure there are plenty, but what stands out for you?
Look, it is you can the interpretation of the provision, right? I mean, we're really relying upon AI in certain cases to help interpret these
Yeah.
multiple agreements,
Mm.
but there is still how you prompt engineer that is always going to kind of shape the response that we're getting. So I think there is that need to really kind of be aware of how do we phrase it so it gets correctly automated,
Yeah.
right? And I think that's going to be where there's going to have to really be that kind of, I guess, that intersection between the legal and the
Yeah.
technical really working together to understand that. And then even to a certain degree, like I said, how do we, when we see new markets develop, when we see new asset class, or we see any markup develop, it really requires kind of some of the big legal players to sit with the technical, to sit with even the financial parties,
Yeah.
to kind of agree on standardized documentation that will allow for
Yeah.
that automation process to become more efficient, right? The more diversity we have in terms, the more it becomes difficult to make sure it's being properly automated,
Yeah.
right? So if we can standardize the documentation to a degree to kind of help build the efficiencies in the market, the reduction of negotiation or the reduction of those possible scenarios where the automation is not matching up to the actual document, right? And so if we can develop that standardized documentation, kind of agree on that
Yeah.
on a market-wide basis, not just on this is this law firm's standard trustee, this,
Yeah.
like it becomes more of a standardized, that is when we see markets really grow. We see the efficiency come in, the legal costs are reduced, the likelihood of execution increases. All of that kind of is what is going to be necessary to kind of standardize the documentation, standardize the automation process, and making sure that we're kind of aligned and that we reduce the risk associated with that.
A couple of things that come from what you've just said there, and like one on the standardization thing is that we see these projects as, if they're done well, they become potential reference use cases that make it easier for us to do further work in a similar vein to what's here, whether it's for securitization or it's for something else, because we built sort of like what can become standards. There's much more agreement that needs to happen. And then secondly, what we see an interest from the AI side of things, where you mentioned prompt engineering. Like, we know from the work that we've done, Arturo, myself, and even Chris, the guy behind the camera here, that when it comes to having guardrails around the AI and what its outputs are, it's not just having like good prompts, but we would also be deploying things like having a way to have humans, not just humans. They talk about humans in the loop. I'm saying experts in the loop.
Yeah.
Lawyers that really know their stuff as the ones that can pick what are the documents that this thing needs to look at. And then that's context. The second thing is the execution steps, like what is a valid process for the AI to go through, the prompts that it chooses, and the breakdown of those steps, because we've seen just much more accuracy from that. So no doubt we'll be working with you to figure those things out.
That's a great point. And I think it goes to the whole question of what's reasonable, right?
Yeah.
And I think for lawyers, and I think most people, we say lawyers, but I don't think we recognize that we're really effective project managers in many ways that kind of make sure that everything is happening in sequence, that we're doing the reasonable levels of checks, diligence, and the like. And how do we then work with you to make sure that that's being done, right? And how are we doing the verification process of what AI, and how are we, like you're saying, because you're right, the guardrails and all the like, and the human verification that sits behind that to ensure that everything is being done correctly, accordingly, or at least in a way that sits with the legal analysis, right? So I think you're hitting it spot on. And I think what we always come back to is what's the reasonable level, as you talk about verification, of
Yeah.
diligence that we kind of to get that nomenclature matching of what is proper and what would be the standard that we should check to,
Yeah.
and what would be okay to move
Yeah.
forward on.
I think that feedback is certainly important. We might have all of these AI tools and we're playing around with ways that, you might design something or even have the AI design a certain workflow, but allowing the experts to then give feedback
Yeah.
and have the AI take into account that feedback and improve it further is going to be really interesting part of what we can showcase with this pilot. But the second thing is just going back to the whole blockchain side of things. When it comes to, let's talk about limits around, say, legal enforceability of smart contract-based asset flows. What
Mm.
do you think are the things that people need to keep an eye out for? Because people that are watching this are working on their own projects. They're not necessarily part of Project Acacia, but they're other people that are working in this space. And they might not be aware of what some of these like legal limits are or legal enforceability limits. From your perspective, what are things that, people in the blockchain tech space need to take into account around that?
That's an interesting one. And I know if it's hard to kind of tell them
Mm.
what they should take into consideration, because look, we sit there and we advise multinational, huge shops. And I think it really is just probably taking it back to your earlier question, that intersection between legal and tech.
Mhm.
And just really, because there's no way, look, what we do is issue spot as lawyers and probably help you identify what are the issues with regard to enforceability.
Yeah.
What is the likelihood, right? Like there's so many, we talk about trustee shops. I used to always laugh when I came here and people would want us to give them a matrix,
Oh, okay.
right? Like a matrix of what's enforceable, what can they push, what should the terms be. And it's never that easy, right? It's never quite that easy. We can give it to you, and like I could probably explain to them some things that they should look at, but the devil's going to be in the details. It's going to be contextual. We're going to have to work with you to really kind of get your head across
Mm.
what's enforceable, and also not to push the boundaries, right? Like I used to always laugh, people wanted to be identified even for their gross negligence. I'm like, that's not legal. That's not possible,
Mm.
right? But they wouldn't want it. And they said, well, let's just put it in anyway. And I was like, okay, well, then you need to be concerned about putting in a severability clause so that it gets read down to what is legally enforceable
Oh, interesting.
without basically kabooming your whole contract, because
Yeah.
we want to have a reaching clause here.
Oh, wow.
So like it is, I've had to give people many instructions about that. Okay, like, look, if you want to put this in, we need to put this in to make sure that it gets read down so that we're not basically getting rid of all your protections.
Wow.
So like this is the kind of thing that we need to kind of educate people, remind people of. And it's, when I say that, this is kind of gets me excited because you're actually building the capability and the knowing across a market versus building institution. Like we have to kind of educate individuals within an institution.
Yep.
And then those individuals then carry that institutional capacity and they leave and that knowledge goes. So this is a way, if you're kind of building this into the process, into the smart contracts, into like a standardized process, then that becomes part of like a market knowledge base that doesn't get eroded as people leave, as institutional capacity is lost.
The knowledge stays.
The knowledge stays, and the efficiencies are built in. So there is, like, if you think about it from that perspective, the kind of how exciting this can be.
I think it's certainly exciting for many reasons on the innovation side of what we can do with the tech, but what people need to, I think, from this episode especially respect more and more is that we actually get to push and test the boundaries in a good way. Like when people say test the boundaries of the law, it's like, oh, just how legal can things be? No, but it's more like what is possible around having a better way to actually run things and do these innovations that have legal structure that is properly backing it, rather than just going out there into the wild and hoping that what you've done isn't going to be illegal after the fact. We know that lawyers, like there's a lot of lawyers in the blockchain space, and a lot of them say that you should talk to us very early on.
Yeah.
It's even more important now that we're doing things that are not just little tiny experiments, but they're actually at national scale, even sovereign nation level, if you take and extrapolate this further. So I think really important what's highlighted here. Do you think that there are ways that if groups are trying to tokenize their structures, whether it's for securitization or for other workflows that you see in the financial markets kind of space, do you think there are ways that trustees can like proactively de-risk? Well, like even for blockchain, were there ways that you thought that, okay, if only we had technology trustees, things could be done
Oh,
for them.
so much better. I mean, yeah, without a doubt. Yeah, look, and I think people have to understand, and maybe because I've sat in trustee shops, I've seen kind of
Mm.
the back office functionality.
Mm.
I've worked with trustees, and you're trying to even collect documentation or understand the current state of things.
Mm-hmm.
How often that takes work to even like, so when I get excited about having this kind of memorialized record of a transaction that's kind of on the blockchain that we can readily access, we know where to go to, we know where to
Yeah.
get it, we kind of have a current state at our fingertip, right? And we can access the documentation. How much more beneficial is that going to be? Right? How much does that kind of alleviate some of the concerns, the pressures for the trustee shop? And then also I start to think about just deal efficiency and being able to get this done in a quite efficient manner. That there are some real realities that as we just pursue greater automation, use of technology, you know, access to record keeping, access to deal flow, all of those things. And even to the extent that we're leveraging AI for them to better,
Oh yeah, yeah, yeah.
like, I mean, really, because I mean, I don't think people also understand the need to kind of monitor
Yeah,
the receipt of, and let's take it to an administrative agent for
sure.
a loan, right? Like a loan facility, right? There is a whole idea of getting the compliance certificates. Have you verified the compliance certificates? Have they been received? I mean, they're getting administered, like, but how does that really work? And I like a lot of times when I do see things going to default or going to that dangerous, those murky waters, it's because maybe that compliance function was not being done at the
Interesting.
highest level, right? There was
Yeah.
kind of, we were seeing already that credit was starting to creep down, or we didn't get a compliance certificate.
Yeah,
No one
yeah.
flagged that they didn't receive a compliance
No one
certificate.
saw it. Yeah.
I'm always amazed when I'm being pulled into that, how when I start to ask the questions, they're like, oh, we didn't get that last compliance certificate, or we didn't see this. And
We're relying on humans.
we're relying on humans, and oftentimes burdened humans
Yes.
who have a great deal of deal flow,
Yep.
who may not recognize the significance of that. And again, does that lead to their standard of care that they should be, or their fiduciary duty? And what does that look like? And does that expose them to liability? So how can we reduce that human error, that human concern? Yeah.
It's really interesting stuff, and I think that what's going to be important is that there's a whole heap of consider them stakeholders, not necessarily counterparties, because we're all not dealing together yet. Would love them to talk to us, whoever they are. But in terms of stakeholders, it's trustees, it's the projects themselves, it's lawyers that are thinking about this. That firms already may have lawyers that are acting on their behalf, but maybe they haven't had to look at this kind of stuff. There's lawyers, no doubt, for each organization and entity, whether it's the trustees or the blockchain tech firms, or even, let's say, AI firms that want to get into this kind of stuff. I think for everyone that's involved, just given that we are being humble here, we're pioneering,
Yes.
the kind of stuff that is the future of finance. If you're a trustee or a structured finance lawyer that's listening to this, and you haven't touched tokenization yet, what do you think their next move should be? Like, you started to wrap your head around it as we were bringing this project to life. Like, do you have, I know it's early, but do you have kind of like any advice for groups that are out there that are starting to look at this, especially the
Yeah.
trustees?
Yeah.
What things should they think about?
I think it's always pulling together the various stakeholder groups and
Uh-huh.
starting to pull. Look, you're talking about, there's so many parties. Like, let's talk about your use case there, right? It's that securitization chain has so many parties involved with varying interest
Mm.
and varying concerns.
Mhm.
And it's really important to get all those stakeholders to the table.
Mm.
And I mean, one of the things I kind of credit, we oftentimes are working with the trustee, the custodian, and the fund manager across understanding the various touch points for them
Yeah.
and making sure we're addressing it in a consistent process, right? Trying to figure out how do we address it in a more streamlined way that gets efficiency in a deal. So I think that is probably the biggest concern, is how do we
Yeah.
form a group of the relevant stakeholders
Yeah.
to kind of address the efficiencies, address their various concerns, reduce their, how do I say, any
Fear.
fear, any fear that they may
Yeah.
have about their exposure, about their concerns not being addressed in this process, about them sitting there exposed more maybe than someone sitting next to them, right? And how do we get them to all kind of lean into this process to recognize how it can reduce, how it can increase the capital flows, increase their volume, decrease some of their liabilities, and survive that cost benefit analysis that they're probably struggling with. I mean, look, you're also talking about lawyers, and
Yeah.
lawyers are oftentimes the most risk averse parties in the room, right? We're the most resistant to technology. It kills me how the gestation for legal tech is probably the worst, right? Because we're the slow adopters. So it is trying to get those parties probably to lean in the most and to really kind of understand it and to really get their heads around what does that look like, right?
I think it's interesting that you say that last point there, because we see a lot of like whether it's legal AI related products, there's a lot of focus on that because I think there's a massive opportunity, and it's a space that plays really well into tools for knowledge management, yet there is that aversion to change, which is why I think it's great, because there is this need to prove yourself more.
Yeah.
It's not just a space where it's like, oh, it's okay. Well, it creatively, made up a new menu for me for my restaurant and it made a few mistakes. That's okay. But in a legal sense, it cannot make mistakes. Or if it does, there has to be the humans involved, the experts in the loop, as we say. So I think it's a nice kind of like bringing together of emerging tech, blockchain and AI has to reach these much higher standards, because we're working with lawyers. It can't just be that, oh, it's okay. No, it has to be very good.
Very good. Very good. And lawyers, I've been at firms where everybody's had the discussion about the Kodak moment. Like,
Yes, yeah.
we constantly get presented with that Kodak moment. And this is another Kodak moment, right? Are we going to lean into this? Are we not going to be fearful of that? And look, it is going to make some mistakes, but we also got to be cognizant of the mistakes that are made due to human error. Right? There are, I can look through a document and find them as well,
Yeah.
right? And and whether it's coming out of some of the best law firms globally. I have corrected work from New Zealand, Singapore, US, like I correct them still.
Wow.
So that doesn't change. So let's stop acting like because AI makes a couple of errors, it should be scratched off the list. It shouldn't. It should something we should lean into, figure out how to work it, how to improve it, how to have that human layer sitting behind it for verification purposes, which you always put forward, and I appreciate you for that. So look, I think it is leaning into that and making sure we're working together to get it done.
Fantastic. And if people want to learn more about your thoughts on all of this, where is the best place for them to reach out?
Well, Madison Marcus, the law firm. You can follow us on our LinkedIn profile, follow me on my LinkedIn profile. Just reach out that way. Best.
Put it in the show notes, so definitely worth checking it out. And folks, for more insights into the legal structures, the excitingness of what the conversion or the connection between legal, tech, innovation, and just having all these reference and standard use cases is going to be, Eric will bring you back on for another episode.
Look forward to it.
Thank you.
Appreciate it.
There you have it, folks. Some great insights there from Eric on the article, on his thoughts on what it's like to bring blockchain and on-chain things to the legal space and trustees. We're going to bring back on for more insights into what it's like from the legal mindset, because you can't just have all of these things and innovations on chain unless there is that legality to it. So going to be really interesting, especially as we progress Project Acacia and other things that we're doing here. If you've got any questions for myself or Eric, please do make sure to reach out. That's it, folks. Thanks for watching another episode of the FEX Insights podcast. This is episode 11. Stay tuned for episode 12 and make sure to like, share, and subscribe.